You're a homeowner with tons of equity in your home and you don't know how to access it. If you're thinking about paying off debt, funding a business, buying an investment property, or renovating your home, choosing the wrong loan could hurt your finances. Right now, you could be sitting on $100,000, $200,000, $600,000 of trapped equity, but you're probably asking yourself, how do I use this equity? What's the best option for my equity? And could I risk losing my home? So if you have any of these types of questions, this video is going to be for you. My name's Darren Tsai. I'm a licensed mortgage and real estate broker in California, and my channel is dedicated to helping people just like you build wealth through real estate education. In this video, I'll cover 3 different loan options that can help you get cash from the equity in your home and share my opinions on them. And before we talk about those 3, I'm just going to cover what equity is. Equity is just the value of your home minus your current mortgage balance. That equals equity. So an example, if your home is worth $900,000 and you have a $300,000 loan, that means you have $600,000 in equity. If you have a $900,000 home and you don't have a mortgage at all, congratulations, you have $900,000 in equity. I chose these numbers as an example because I talked to someone last week that had this specific scenario. The 3 options, number 1, I'm going to categorize as the HELOC, home equity line of credit, / HE loan, the home equity loan. The second one would be a cash out refinance. And the third would be a home equity investment, HEI, sometimes also known as a home equity agreement, HEA. So I'm going to start with the HELOC, the home equity line of credit. Now, the way the HELOC works is it's like a credit card against your house. So you get a credit limit and you can borrow what you need. Now, the HELOCs typically have a variable interest rate, and what that means is it's usually going to change every year or every 6 months, depending on the terms of your loan. Another thing to note about the HELOC is that payments are typically going to start out a little bit lower because you're paying interest only. And then after 10 years, you're typically paying interest and principal back. And not to mention, your payments are going to be changing. So they're not always going to be the same because your rate is variable. Personal story is that my family used a HELOC to build an ADU, and we chose the HELOC over a cash out refinance because we didn't want to have a high monthly payment the entire time we were doing construction, because in construction, you pay kind of as completion happens. So we ended up not drawing on the entire HELOC at once. We took out sums of money when we needed it. HELOCs are good if you have different projects or if you just want a line of credit down the road. And I would say the biggest risk with the HELOC is that the rates could change. So your payment could go up. In my specific scenario, the payment doubled. It went from about $800 a month to about $1,800 a month. But we kind of anticipated that. We knew rates weren't going to stay low forever. And we factored into all of our calculations that, yes, $1,000 extra a month on the payment would not kill us. We can handle it. And that's also why we didn't take out a bigger HELOC. We took out an amount that we knew we could always pay back. And similar to a HELOC is the home equity loan. So with the home equity loan, you're going to get a lump sum of cash with a fixed interest rate. So this will allow you to have predictable monthly payments. It's usually fully amortizing, so you're not just paying interest only, you're paying down the loan balance every month as well. And with this, you typically know exactly what you're getting into. It's usually a little bit different than a cash out refinance because the cash out refinance, you're replacing your first mortgage. With the home equity loan, you're typically not touching that first mortgage. So if you do have like a 3% or a 2% interest rate, congratulations, you're a big winner in all of this, but you're not going to replace that mortgage with this higher interest rate second. I do personally like the HE loan because you know what you're getting into, you know what your monthly payment is, and this could be a good option to pay down a big chunk of debt if you have it, or maybe you just need some funding to start a new business or something like that, or maybe you want to buy rental property. At least you would have that fixed payment. Now, the second option here to pull cash out of your home is a cash out refinance. It's going to replace your first mortgage. And so if you have a higher first mortgage interest rate, maybe like a 6 or a 7, but you want to tap into some of your equity right now, the cash out refinance could make sense, but you probably will not have lower monthly payments. And so the cash out refinance will pay off your first mortgage and give you some cash in addition to that. And so you actually can choose if you want a fixed rate or a variable rate with this one, but they're typically fully amortizing. And this is similar to the HE loan in the sense of if you need some cash to pay off some debts, or you're consolidating debts, or maybe you just want some cash for renovations and the rate is similar to what you're already paying right now, this option could make sense. Okay, so the last one, the third one, home equity investment, sometimes also known as a home equity agreement. These are a little bit newer of a product, but there's no monthly payment on them. So essentially what you're doing is you're giving up your home's appreciation and you pay a share of the appreciation at some future time back to this company, and they just give you cash right now. There's no monthly payments or anything. And I personally don't love these products. I think these products are a little bit confusing. They're not that transparent in terms of how much someone is really giving up for this loan now. But I think in the long run, these products actually hurt people more because you're giving up a share of your appreciation. Now, in most of the markets that I work in, appreciation is the biggest piece of someone's wealth building. If you think about someone that bought their home 20 years ago, most of the time their biggest asset is their home. And if they gave up 20 or 30% of the appreciation in their home, that means that they would have 20 or 30% less of their net worth. And the thing about these products is that you usually have to pay them back if you refinance, sell, or if you pass away. The only situation that I do see this potentially being a good option is if you have some equity and you need cash now, but you're going to sell your house in 3 or 6 months anyways, because there's not going to be like this large piece of appreciation for you. So that's the only scenario where I could see this one maybe working. And so for the most part, I don't think these programs actually give that much in terms of a loan. So I actually have a client who she was looking into one of these options. She has a 800 credit score, a $2.2 million home, and she wanted to pay off her $250,000 HELOC without touching her first mortgage. The HELOC is a second, and the max amount she was allowed on a home equity loan was only $180,000. So if she would have done a cash out refinance, she could have easily paid off the HELOC and got some cash. If she did a home equity loan, it's the same thing. But even just getting the estimate from one of these companies, I was surprised at how little they offered in her scenario. So now that we've gone over these different options, I'm just going to put it in this nice little table for you. So first, the loan type is a home equity line of credit. It is a line of credit, meaning you can draw on it when you need it, and you only pay interest on what you draw initially, usually for the first 10 years. Then after a certain amount of time, then you're paying back the principal and the interest. One of the main risks of the home equity line of credit is that the variable interest rates can increase your payment. And so if you are not aware of this and you cannot handle these increased payments in the future, that is a risk of losing your home. So make sure you plan ahead for that. Now, some of the best uses for HELOCs is they're great for renovation and small projects, and they're just great to have as an available line of credit for emergencies or if you find a great investment opportunity and you have a plan to pay back the amount that you drew on. The next one is the home equity loan, right? So you're going to get a lump sum, which means you're going to get paid all that money at once, but now you have fixed payments. It's going to be easier to budget with that, and you don't have to touch your first mortgage if you have a 3% or lower, even a 4%. So it doesn't touch your low rate first mortgage. So if you have a 5% or below, then yeah, you're probably good. You probably don't want to touch that at all. Just leave it. Now the risk here, obviously, same thing, is you're going to have a monthly payment. So make sure you can handle that monthly payment for the term of the loan. I think the HE loan, the best use of it is usually debt consolidation, really. If you have a high amount of monthly debts and you can increase your cash flow by taking a lower interest rate, that can help. Or if you have maybe long-term projects that you need a fixed payment for, this could work great too. Cash out refinance, similar to the HE loan in the sense that you're going to get a lump sum, but it does replace your first mortgage. So you might not actually get as much cash. Depends on the scenario, obviously. Now, the benefits of this one are you get some cash, and maybe if the rate's lower, then you have a lower payment too. But right now, unless you have like an 8% mortgage rate, you're probably not going to get a lower interest rate. Now, obviously, the key risk, this is just with any mortgage, is if you can't pay it, then you potentially lose the house long term, right? But normal uses of a cash out refinance, right? Debt consolidation, long-term projects, renovations. We see that a lot for home renovations, and more commonly now, building ADUs. Now, last but not least, the home equity investment or the home equity agreement, the HEI or the HEA. Same thing, you get a lump sum, and the main benefit is you don't have a monthly payment on this. And then obviously if your home value goes down, then the amount that you could potentially have owed them is not going to be as high, but you still owe them the loan balance. Now, the key risk with this one is that you're getting fleeced for the biggest wealth building tool that you have, your home. They're taking a big portion of your appreciation in the long term. And another risk is that many of these providers will not give you enough funds for the projects or the things that you need. So I do think, best use for this one is like if you're selling your home in the next like 3 to 6 months and you need the cash now, well, maybe look into this option. And so speaking of options, if you want to see some of yours, this is a free thing for you. It's a monthly paid service that I have. It's called Homebot. You just put in your home address and then it will show you some different options with your equity. My clients love it. They get a monthly report and they look through the different options they have with their equity. Once again, it's free for you. Links down below. So if you have a ton of equity in your home, but you don't know how to access it, hopefully this video gave you some ideas and at least it gives you a starting point. And if you want to have a conversation with me about your specific scenario, you can go ahead and email me at darren@realdarrensci.com, or you can text me at 714-887-5432. Thank you so much for watching my videos, and I'll see you on the next one.